What is up, my friends? Welcome back to the channel. In this video, we're gonna cover the 7 mistakes to avoid in 2023. Now, I know that is crazy out there. We just had Silicon Valley Bank basically collapse, Silvergate, and another one. So 3 banks in like 1 week. Right now, there's another 30 banks that are systemically high risk. They're at risk right now. Wells Fargo is on that list. Fifth Third Bank is on that list. I even think Amex is on that list. So a lot of banks that were all saying, hey, we're fine. All of a sudden now that, daddy has opened up his wallet are saying, no, we're not fine. So that is something to pay attention to this year. I have been saying this since last year. 2023, I think, is going to be really, really rocky. I think to feel okay and to make smarter decisions, we need to plan. So what's funny is like this list of 7 things, it's really like 3 things and a bunch of other things that happen because of those 3 things, right? And so the thing, if you want to just, X out of this video and just get, quick hack, quick tip right now, make a plan. The planning is gonna cut down on your emotional response. The planning is gonna cut down on your stress. The planning is gonna cut down on your FOMO. The planning is gonna cut down on any weird, irrational, emotional decision that you might possibly make by not having a plan. There you go. You can exit the video now. Okay, so for everyone else that wants the nitty-gritty details, let's dive into it. First thing, don't let your money sit around. So it's sad, but a lot of people just, they get their direct deposit right into their checking account, and that money just sits for days, weeks, not months. I'd say most people are using that money fairly quickly, and they're executing and using that money out there to pay credit card bills, to pay for their groceries, to pay for all of these things. That money in your checking account, I hate to tell you, is dead money. It's dead money. You're not getting anything back on that. If you're lucky, you're getting maybe 2% back on your, your debit card spending. But most of that is just gonna be dead, stagnant money. We want to remove that as much as possible. We want to either use credit cards in place of using a debit card for a lot of our monthly purchases so that we get a cash back on that. We want to start to allocate this money in different places so that we can get some sort of APY on that per year. Right? That's it. Number 2, avoid growth stocks. So we're gonna start to get into investing type stuff, but it's kind of funny how many parallels there are of investing advice to just like regular everyday life advice. Okay, so avoid growth stocks. There was a ton of tech companies and essentially companies that have to continue to grow, have to continue to innovate, have to continue to roll out new programs, services, products, whatever, in order for the investors and the pool of people who are putting up their money to buy the stocks get excited about it. That's essentially a growth stock. Now, the issue with that is that so many of those companies got so used to 0% interest rates for so long, they're floundering right now. And a lot of them, what we started to see was whether you saw viral TikTok videos of day in the life videos at like Twitter, Facebook, and all these major, TikTok headquarters, and that proved it, or you're just starting to find this out, the clear amount of layoffs that have been occurring point to the big glaring issue is that a lot of these companies, first off, they failed to pivot. And now they're overly doing it. They're being overly aggressive with cutting staff, cutting wages, cutting everything, in an attempt to pull back on, losses, right? And so the same thing actually happened with Silicon Valley Bank that just fell, is they were so used to the cheap money, the 0% money, that they just failed to pivot. You know that they didn't have a chief risk officer from April 2022 until like this collapse just happened? So for almost a year, they didn't have a chief risk officer or operator, a person that can actually, help them change policy and change the way that they do things. And you wonder why they did not pivot at all, and then they now are completely belly up. Well, that's how that happens, is that we have nobody overseeing and paying attention to what's happening in the deep structure of the company, and then big change occurs in interest rate. I mean, from 0 to 5%, like we all saw this happening every single time they raised interest rates. So there's really no excuse for it, but that's how that actually happens. So growth stocks, I think, are a horrible idea for the next probably 12 to 24 months because they're gonna get absolutely hammered. Every time something happens with, some sort of subsector, those are gonna take a beating. They're gonna take a beating over and over and over again. So that's not where you wanna be with your money this year. And I would actually add a little caveat here. Maybe this is number 8, if you want it to be. With real estate, you wanna look at things very similarly, is you do not wanna be focused on fixing and flipping over the next 12 to 24 months, which I have no clue why this even has to be mentioned. But it's like, the real estate market is soft. Mortgage rates have gone up. Everything has gone up. Why would you possibly think it's a good idea to buy a house and fix and flip it? Now, unless you're getting this house at a ridiculous deal, right? A borderline disrespectful offer that you've put out and somebody said yes to it. Unless that's the case, I would say avoid those completely, right? Okay, number 3, missing payments or allowing yourself to get put behind the 8 ball with any of your trade lines. Now, we could come up with easy excuses all day as to why this might have happened, why it happened during COVID, all the things that came up, right? We get it, okay? I will just say, you gotta fight tooth and nail not to let that happen, especially this year. Do not let yourself get put behind the 8 ball. And if you're still cleaning up from 2020, missed payments and things furloughing and things that you had put in place then, we've got to get really aggressive this year with making sure that we stay up on our payments, at least the minimum payments. Make sure we've got all of our dates scheduled out, set Google Calendar alerts if you have to, alarms on your phone, whatever you gotta do, make sure those payments are getting made. We do not wanna be falling behind this year, because that leads to number 4. If we start getting behind, we need money, and that will force us to do what? Something stupid, something we don't wanna do. Being forced to sell off assets because you have to pay bills is not where you wanna be, okay? Because the asset we should keep forever. And then we just borrow off the asset and we keep the asset forever. We just borrow off of it, pay it down, borrow off of it, pay it down. That's how we wanna be treating our assets. And I believe that the primary residence is an asset, even though some people in the real estate space or investment space don't really feel like that, I do. So we do not want to be selling our house at the bottom. We do not want to be selling our stocks at the bottom, our cryptocurrencies at the bottom, or any of these things and taking a huge loss like that. Because the whole name of the game with the investment portfolio should be to hold these things for a really long period of time. Remember, the tax code actually rewards this. I'm gonna get more into this in just a couple of minutes, but the tax code rewards you holding on to stocks and investments longer. Okay, number 5, here's a big one. Becoming overly emotional. Now, when you don't have a plan, when you're not executing on the plan and all of these things are happening, like we're watching the news, we're watching Twitter, we're watching social media, and then this is happening with the banking, and this is over here happening with politics, and this is happening with the family over here, and gender, and all the stuff that's going on, right? All that's hitting us, all that noise is hitting us all day long. And if I don't have a plan for what might possibly come, I'm just adding on and stacking on stress over and over and over and over again. And before you know it, here's what's interesting, is like your behaviors will change. And you won't even catch on to it. You won't even realize it, especially if you have zero awareness towards this. So the number 1 enemy is becoming overly emotional. And then what starts to happen is we make bad decisions, we make bad choices. Then we try and, let's say from a trading reference or a trading standpoint, we try and overtrade to win back the money that we just lost. Or let's say, even worse, you get liquidated. So then you go even harder, you double down even more. I've done this, I've literally liquidated myself. I've done everything you can imagine, good, bad, winning, losing in trading, I've done it. So I can tell you all about like the depth of the emotions that you can go through from a trading standpoint. But right now, the reason why I even bring up that reference is because so many people are trying to come up with ways to make more money, ways to make more income, that they're leaning on traditional areas that are more like gambling, okay? And thinking and hoping that they're gonna get lucky. So by you like day trading or trying to follow Dave Portnoy or some social media influencers or something like that, you're gonna end up getting wrecked. You're gonna end up FOMOing in, like even following people legit, I guess you could say legit people with authority like Chamath Palihapitiya, even following guys like that is not a good idea. That guy, when he was on national television last year talking about how Tesla was the greatest thing since sliced bread, he was actually selling. The 13F filings show that. So even guys like that, like you're gonna get wrecked if you're outsourcing your decision making to somebody else for market or trading advice. Really any market advice or any trading advice, right? And then next what starts to happen is when that advice comes back bad or turns out getting us wrecked, then we start to compound, and then we make worse and worse decisions, and then before you know it, you've like destroyed your life, and you're like all the way over down here in a deep dark place when it didn't have to occur like that, didn't have to go like that. So I've seen it happen. Like it's kind of wild to think about, like one bad trade, you can spiral out of control to like ruining your whole life. I've literally watched guys do this. I've watched guys max out their credit cards and take on $80,000, $100,000, $250,000 in debt in credit, and then lose it all in the market because they didn't sell, because they thought, oh, it could go up a little higher. Everyone from the outside that's never traded before immediately thinks, God, you're such an idiot. Why would you're not gonna sell? I would have sold at the top. I would have made $1 million. I'd be living on an island right now. Guys, I can assure you, most people do not sell the top. They don't. It's just, I don't know what it is. They don't. Most people, they sell the bottom and they buy the top. Okay, so if you want to remove yourself from that, we need to make sure that we're not being overly emotional, okay? And how we do that and add some safety and security, kind of like a gun under the pillow or, some sort of alarm system on the house. How we do that is we make a plan and we execute on that plan. I think this is number 6, trying to time the market. you're never gonna time the market. And this ties into what I was just talking about, becoming overly emotional, making really, really bad decisions and choices, is that you're not gonna time the market. There's actually books written on this. The books that you're gonna wanna check out if you wanna get a better insight into successful investors, traders that made like really great trades, or just are consistently over 30, 40, 50 years, very, very good investors. It's called New Market Wizards by Jack D. Swagger. And you're gonna wanna check out, he's got, I think, 4 now that are New Market Wizards, 3 or 4, and then he's got a hedge fund version of the same thing. New Market Wizards by Jack Swagger. Check it out. Listen to it on Audible when you're doing your cardio or when you're at the gym. Listen to that at lower volume so it just digests into your subconscious. But I'm telling you right now, there's not a whole lot of people that can time the market properly. I mean, Soros is up there as being really, really good. Warren Buffett has done really, really well. But that doesn't actually mean that these guys time the market every single time perfectly. A lot of people would argue that Buffett was way off sides in the COVID dip. He's now sitting in over $140 billion in cash still on the sidelines. He's waiting to make borderline insulting deals, okay? Ridiculous deals. He's still waiting for that opportunity. So he has allocated more cash recently, I think, but overall, that guy's still on the sidelines waiting. There's a lot to be learned from that, right? So are we gonna, like the thing you gotta think about is, am I, with my limited experience, really gonna out-trade, outthink, outsmart somebody who's been doing this as long as Warren Buffett has? Or somebody that's, like that, okay? So instead of trying to think that I can beat everybody, I think that's a good, positive, overall, self-esteem to have. Let's study for those people as well, right? So that we increase our odds and improve our odds. But chances are you're not gonna beat the market. They've got studies on this. Most people lose. It's like 80, 90% of people lose. So don't bother. You're much better off just DCAing, dollar cost averaging over time, especially if we're talking about crypto. When it dips and huge dips, then you wanna buy in, and then you could do the same with your dividend portfolio or whatever portfolio that you're trying to build out. That's what I would suggest there. It's all coming down to this now. I told you 3 things in the beginning that really comes down to. It could all be wrapped under make a plan, because making a plan makes sure that you're not overly emotional, make sure that all these other things are in check and under control. So that's where I want to leave you with number 7 is make a plan. And that's for regardless what you think is going to happen or what you feel might happen, whether you think there's going to be food supply issues, go get shored up on food. There's been a lot of fires. There's been a lot of accidental issues that happened with food processing plants. There's some weird stuff going on with the climate change initiative, right? So if you think that's going to be an issue, go and shore up your means to feed yourself. Whether that's you want to be able to eat meat and eggs, then go do that. If it's something else, then do that. If it's about having backup food supply, water, whatever, make sure you've got those things tackled. If it's about something else like financially, then go and get yourself a life insurance policy. If you don't have one already, get a couple, okay? Go and put 5 to 10K off to the side in a emergency fund. Go and set up your Roth IRA. Go and put money into a CD ladder. Go and put money into I-bonds right now, which are paying out 6.89% until I think March, the end of March or April. So these are all things that you could do right now. And here's what's cool about it, is every one of these things that you get done as you tick them off, right? You're gonna feel better. You're gonna relax a little bit. The stress is gonna alleviate, and you're gonna feel like you're starting to get control. You're starting to get on top of this, because as humans, we're always trying to gain control of things, right? We're always trying to feel like we're in control of the situation. Well, that's how we turn this from being flip-flop Eddie, who's like emotionally in and out of markets, making huge amounts of mistakes, to now we're polished and we're focused, right? So I think we've kind of hit that nail on the head enough times here. What I want to finish on and talk about next is instead focus on doing these things for this year. And I have 4 things. Okay, first thing that you want to be doing is pay off all high APR credit and trade lines. So if you're paying like 24 or 27% APR, that is eating your lunch every single month. You need to get rid of that. We need to pay that off and just leave it as a backup. Go there, try and get a better rate, get a lower interest rate on it, or just leave it open, because it's bad a lot of times to close accounts because it negatively affects your average age of account, and your credit score will drop like 5 to 7 points. But it might have longer term effects. Leave it open if you can, okay? So high APR stuff, 20% and above, because we can't beat that in the market. Unless you can go get something that's gonna pay you 20% annually, then we gotta be paying off our high interest rate credit cards and trade lines first, because then we're essentially saving all that APR. So we're winning after those get paid off, because we're winning in the savings. Make sense? Number two, remember that the tax code itself literally rewards things like dividends and capital gains. And the reason why, they're like literally shining a flashlight on this and saying, put your money here. What are they trying to get you to do? So things like dividend aristocrats, for example, they've been increasing their payout, their dividend payout over the last 25 years. I mean, there's companies that's been paying out dividends for, I think the highest is 58 or 68 years. There's over 60 companies right now that are on that list that have been paying out, increasing dividends over the last 25 years. The tax code rewards you for this. What the government or the IRS wants you to do is park your money for a long amount of time. And if you do that, the longer you park your money in these certain vehicles that they have created, they reward you for it. They reward you with being able to defer taxes, being able to save on taxes, or with things like a Roth IRA, completely sidestep them as long as we're, abiding by the rules and things like that, right? So the tax code is there and it's shining a light on these things for a reason. Take advantage of them. But not only that, we've also got some of the greatest investors in the world who literally do the same thing. So it's almost like they are paying attention to what the IRS is saying, hey, go put your money over here, and then they're going and doing it, right? Which is why you notice most of the most successful investors in the world are doing what? They're holding on to stocks for a long period of time. They're focused on dividend stocks. They're buying land. They're buying real assets, which is something we always talk about on this channel, right? Number three, buy capital-rich assets and just borrow off of them. Okay, the rich, they buy, they borrow, they die. And then that gets passed on to the next heir and so on and so forth. They're never selling assets, okay? And they're removing all personal debt, all personal risk. They're completely taking that off of their personal credit profiles, their person themselves, and putting it out there onto businesses. That is how they shore up and protect themselves, is that they are not taking on that personal debt. They're also not selling off assets when the market goes bad or when there's 2 bad years in a row, or like what we've seen here to where we had a bad 2020 and then things kind of got better and now it looks like we're gonna go real bad again. They're not like, hemorrhaging and bleeding out assets during these periods of time because, as we all know, it's the worst time to be selling. So that's how we want to structure everything that we're doing. We want to buy it, we want to borrow off of it, and then just keep doing that and repeating that over and over and over again. If it's working for the wealthy, it can work for you too. Lastly, if you're gonna make offers out there, if you're gonna try and do deals, make borderline disrespectful deals, is what I would say. Try and come up with some sort of creative finance, because again, at the end of the day, what most people want is they wanna get out of the headache, let's call it the house, they wanna get out of the headache of having the house or having the rental property, and they want cash flow every single month. They want a monthly check and to get out of the headache. That's it. Like, as long as you can solve what their actual problems are, figure out what their actual needs are, and then solve those problems, you're gonna be able to make what even might look like a disrespectful deal, a disrespectful offer, because you've actually figured out like what they want and you're serving that, right? You're fulfilling that. Whereas I think a lot of people make that mistake. They figure out like what the person wants for the price of the house. They don't really ask a lot of deep questions as to why or what the person actually wants. And then, I can't make the deal. House sits on the market for 6+ months, never actually gets sold. So that's why those things happen. The thing I would say right now, more than anything, this year is there's gonna be a ton of opportunity. There's opportunity to be sitting in cash for crypto markets, for traditional legacy. With all this banking madness going on right now, there's gonna be a lot of opportunities that come up. And the same thing with real estate. There's a lot of people that are in over their head now on their house. They can't sell their house for what's owed on it after they pay all the real estate agent fees and all these fees at the end of the transaction, right? They can't actually afford to do that. So if you can come in with a creative option, they might just take it. So that's how we navigate this this questionable territory for this year and probably going into next year. But I'd love to hear your thoughts in the comments below. Let us know what you're thinking. Thanks for watching. See you in the next one. Hey, you should subscribe. 60% of you are not subscribed yet. Right there. Okay, bye.